Hello, this is Patrick Yankee with Yankee Financial here in Raleigh, North Carolina. Securities offered through Raymond James Financial Services. Welcome to this quarter's Capital Markets Review. As always, my purpose is to inform and to answer questions on the economy and the financial markets. This isn't meant to be my prediction for the course of the market for 2018 and beyond. Rather, it's a view of economic and historical data to help investors make informed decisions about their financial futures. Once again this quarter, I've chosen to use slides from the Guide to the Markets produced by J.P. Morgan Asset Management and a couple of slides from Riverfront Investment Group for the simple way they present complex ideas. Most slides have multiple charts on them. I will point out the information I think is most relevant. The opinions expressed are mine and not necessarily those of Raymond James, and JP Morgan and Riverfront are not affiliated with Raymond James. So let's begin. This quarter, the themes are an economic update, followed by interest rates. Let's talk about the equity markets assumptions, and then what investors should do. So I don't have to tell you that last year was a good year in the financial markets. Most portfolios should have gained, and many gained substantially. U.S. markets, as measured by the S&P 500, were up just under 22% last year. Overseas assets rose more, boosted by a softening dollar. Among global equity markets, U.S. markets were least volatile, and in general, more volatile markets gained more. Investors were rewarded this year for taking on risk. This chart shows where the gains were made last year. In domestic markets, most of the gains were made through capital appreciation. Overseas, except for emerging markets, the excess gains over domestic markets were made through the exchange of currencies. Like it or not, the U.S. leads the world economically. When we fall into recession, the world tends to follow. Therefore, it's important to keep up with the U.S. economy even when considering foreign investments. GDP growth was 2.3% in the third quarter. On the right, we're looking at the components of GDP. Consumption always makes up the largest chunk in a market-driven economy. Therefore, it's important as investors to know how consumers are doing financially. Overall, GDP growth still remains low versus historical rates. These four sectors are considered to be the four horsemen of the apocalypse because they tend to lead into recession and also lead out. The top right chart shows that inventories are falling in a stronger economy with businesses. With falling inventories, capital goods orders have also increased. The charts on the left side deal with the consumer, and they are not signaling recession. The recent slowdown in auto sales has ended. Consumers can put off buying a car or finding a place to live for only so long. Eventually, both of these categories revert back to the mean. Although a short-term loss, this is an area where the natural disasters may help the economy as well. Cars and homes especially will need to be repaired and replaced. Rebuilding is still building. Higher home values help create a wealth effect for consumers. Nothing makes consumers feel wealthier and freer to spend money than having their largest asset appreciate in value. Home values have been on a solid growth trajectory since 2012, and housing affordability remains strong. Note the bottom left chart though. When you compare current home prices to average incomes, houses are becoming very expensive. This is good for sellers, but tough for buyers. Those who currently own homes are still experiencing strong housing affordability with low mortgage rates, reducing mortgage payments relative to incomes. When the price of oil fell at the end of 2014, many rigs in the U.S. were shuttered as uneconomic at the lower prices. These shuttered rigs are available when oil prices rise to economically feasible levels. Consumption has grown at a rate of about 1.4% per year historically. Oil supplies have grown at a more erratic rate. Recently, inventories have fallen with a dramatic increase of demand in China primarily, and that has allowed the price of oil to rise again. Note the chart in the bottom left. The drop in the price of oil, with increased inventories, brought about the idling of about 2/3 of oil rigs in the U.S. The higher price of oil has made it more economical to reopen some of the oil rigs already. Because of this, oil will likely remain banded in about the $60 per barrel range, and in the longer term the price will likely rise as demand continues to grow at its historical rate while supplies seek equilibrium. Demand will be driven by economic growth, while supply can be somewhat controlled by oil producers. Generally, when unemployment falls, job prospects have greater leverage in negotiations. This tends to drive up wages. However, in this economic expansion, wages remain flat despite a significant fall in the official unemployment rate. This shows the softness of the real jobs market. When you're looking at the official unemployment rate, what you're looking at is the results of unemployment compensation. Those that are no longer eligible to be compensated are not measured, so they fall off the rolls. That's one of the flaws in using this measure alone. One way we can measure the true level of unemployment is to consider the labor force participation rate, and that's the chart in the upper right here. This shows the percentage of the working age population participating in the labor markets. At under 63%, we're at levels of participation not seen since the mid-1970s, and that's reported by multiple media outlets. As the economy strengthens, the recent trend has arrested its descent, but it remains low still. Some of the drop in the participation rate is attributable to people leaving the labor force due to aging or retiring early. Some economists are predicting that the low unemployment rate will keep GDP growth rates muted. This thinking has some of them calling for immigration reform as a means to provide a supply of new employment. This is an area where I disagree with those economists. Although the official unemployment rate is low, the economy is not without prospects for new employment. The labor force participation rate is a source of sustainability for continuing expansion. Consumers' balance sheets are very strong in the aggregate. Total assets have reached new highs, while liabilities are very low. In fact, the amount that debts are costing households as a percent of disposable personal income remains at extreme historic lows. Another thing to consider for the consumer is the fact that after 7 years, bad debts fall off credit reports. Access to credit adds fuel to consumer fires. We are beyond the 7-year point from 2008, and consumers have greater access to credit and more spending power than they have had in a decade. Another thing to note about this is that rising interest rates won't have a strong direct impact on consumer balance sheets. 2/3 of their liabilities are fixed in mortgages, which won't be directly affected by rising interest rates. The federal government's finances have improved from the last number of years. At the peak, the federal government was borrowing more than 35% of every dollar it spent. However, in the last couple of years, the borrowing rate has grown from a low of about 12 cents of every dollar to 17 cents of every dollar now. Long-term forecast calls for borrowing levels to increase going forward, and at an increasing rate over recent quarters. It's interesting to note that Congressional Budget Office expectations for deficit spending do not yet reflect economists' expectations for higher growth rates. If higher rates of growth are realized, this can help federal finances through greater tax revenues. Time will tell on that one. Manufacturing indices are extremely healthy. It's not often we see all areas of the world growing robustly at the same time. This shows the breadth and strength of the global economy. And they are stronger this quarter than they were last quarter. Inflation remains tame, well below historical averages. However, there are areas of the economy with greater than average inflation. Unfortunately, some of the higher inflation items like food, housing, and medical care affect everyone, while some lower inflation items like recreation and transportation don't affect all economic participants. The future will likely see a return to more normal rates. If economic growth rates accelerate, higher inflation is likely to be one of the consequences, especially with an expanded money supply. Inflation assumptions can be a starting point for investment assumptions. Starting with low inflation and having it rise is a scenario we've seen 8 times since 1974. In this environment, equities and commodities have been the best performers, although I maintain that the commodities number is skewed by the late 70s, but more on that later, and bonds and cash have not fared well in these environments. So let's talk about interest rates. After falling for the last 31 years, bond yields remain at historic lows. Average nominal yields for the long term have been around 4%. This means that the nominal yield on the 10-year Treasury would have to rise over 1.5% just to get back to historical averages. The long-term outlook for interest rates is a rise toward the long-term averages. The movement of interest rates will impact bond investors as they watch their values fall. Falling bond values will also make bond holdings illiquid, as asset bids may not match realized results when sold. This is a dangerous environment for bond investors, as rising interest rates may counter coupon payments and really remove the reward from the risk-reward equation. When interest rates return to their mean value, how much more can be lost in the bond markets? Well, from current levels, a 1% rise in interest rates will see almost 18% loss in a 30-year Treasury and almost 8.5% loss for a 10-year Treasury. Those with significant bond holdings, especially with Treasuries, should carefully consider their asset allocation. Among all bond categories, only convertibles, floating rates, and high-yield securities would see positive returns in this environment. The Fed expects to continue on a path of raising the Fed funds rate. Market expectations show what has already been priced in. There is still some uncertainty with the Fed's ability to follow through, or really with the need for the Fed to follow through. It's nice to have higher interest rates so the next time the market turns down, they can lower interest rates to provide a stimulus to the economy. However, among the developed world, we have the highest interest rates in the world currently. There's no market pressure that says our interest rates need to go higher from here, and that's part of what the Fed is fighting. But the Fed has embarked on a program to reduce its balance sheet, which has grown from less than $1 trillion in 2008 to over $4.5 trillion now. Their plan is to cease purchasing assets and then not rebuy maturing assets as they come due. Although announcing a reduction of about $50 billion a month, the actual rate is dependent on the schedule of maturing assets. If they follow this plan closely, it will take about 5 years or more to reach their targets. Another reality check for this plan is the need to maintain liquidity in the debt markets. The Fed will not allow a failed Treasury auction. As long as the federal government continues to borrow with deficit spending, they will continue to issue bonds, and the Fed will be there to ensure all federally issued bonds are purchased to prevent cascading losses in the bond markets through a failed Treasury auction. One telltale sign of impending recession is an inverted yield curve where short-term interest rates are higher than long-term rates. Despite flattening over the last 4 years, the yield curve remains positive. Expectations are that the Fed tightening interest rates will also lead to higher long-term rates as well. An inverted yield curve has been a fairly consistent signal of impending recession. So let's talk about equity markets. Between March 9, 2009 and the end of December of 2017, the S&P 500 increased by almost 300%, excluding dividends, and that's a huge increase. There's hardly a period of time that is shorter than the period of time between when the client thinks it's too early to get in and the market analysts think it's too late. Those with a short-term view of history would be forgiven for seeing a market peak at these levels. Consider, though, that we've been through what's known as a secular bear market. There are really two phases when evaluating PE ratios: the secular bear, where PE ratios are contracting, and the secular bull, where PE ratios are expanding. The only way you know you've gone from one to the other is in hindsight. Through the recent secular bear, forward PE ratios contracted from about 27 times earnings to their current level of about 18. The yield on the S&P 500 is competitive with 10-year treasuries currently. So although the recent number of 18 times earnings for forward PE ratios is a little above the 25-year average, it's not reaching toward extreme levels. It's still below one standard deviation from the 25-year average. Holding all other things static, earnings growth will lower the PE ratio, and we are expecting earnings to continue to grow. The question will be how quickly stock prices move in relation to earnings. We can look to history for a guide as to what's possible, though. The last time PE ratios were at this level was the beginning of 2004. From the beginning of 2004 to the third quarter of 2007, PE ratios actually fell. In under 4 years, PE ratios went from above average to below average. And despite the reality of falling PE ratios during this period, the S&P 500 equity values actually rose 11% on average per year. That rate is in line with long-term averages and would be greater than the single-digit returns we've been told to expect in the new normal. Does that mean markets will behave in exactly the same way this time? No, it doesn't mean that. It simply means that those who use this one measure to predict lower than average returns going forward may not be correct this time either. It isn't a mathematical certainty. The main reason to invest in equities is the earnings of the companies on the exchanges. Although earnings dropped some quarters ago, earnings have picked up and have resumed their track to record levels. The drop in oil prices and the rising dollar have been the biggest stories in this area. Nearly half of S&P 500 revenues are derived from overseas sources. Energy companies and peripherals are obviously suffering with lower revenue from lower oil prices. Multinational corporations are also suffering as they repatriate earnings from overseas. Stabilizing the dollar and oil have made things look much better very quickly. Earnings are increasing, as are future projections. The important thing to realize is that the PE ratio has two components, price and earnings. We tend to assume that the overall ratio is driven by price. When PE ratios are rising, markets must be rising. When they're falling, market values should be falling. The reality is that both factors are important. PE ratios fell from the beginning of 2004 to the third quarter of 2007 because earnings rose faster than prices. The forecast going forward is that the recent earnings doldrums are ending, and earnings will continue rising robustly for the time being. In this environment, equities have room to move higher without moving PE ratios to extreme valuations. This chart shows secular bulls and bears. The secular bear markets are noted by the horizontal lines. It is normal that the markets move to new highs after lows in the PE ratio. It is somewhat cyclical. The average secular bear is 14 years long, and the most recent started in March of 2000. Is it over? Only time will answer that question. However, strong market performance shouldn't deter stock investors with a broader view of history. We seem to have broken out of the recent bands of market performance, but that doesn't guarantee a future without significant volatility. Another way to look at market valuations is through the prism of history. On average, going back over 150 years, equity markets have returned about 6.5% per year to investors. Sometimes, the market gets to extremes above the trend line, and forward returns are reduced for investors. Sometimes, the market gets to extremes below the trend line, and investors realize higher returns as the market returns to the mean. Currently, market returns have returned to the long-term trend. This suggests that investors could expect average returns going forward for the long term. In the short term, returns may be higher if the market continues to grow beyond the mean. Once again, we'll only know in hindsight. This is a slide from the prior presentation, but it tells a still relevant story. There are some rumblings that this bull market is too old and has been growing too long to continue. The reality is that this bull market is neither the longest lived nor the highest flyer of the post-World War II equity markets. Bull markets don't die of old age. They end when robust economic growth creates imbalances which take a recession to resolve. This is not yet happening in this economic expansion. This slide is from last quarter as well. The news is filled with sensationalism every time the equity markets hit a new high on the indices. Here's the reality. Anytime the market is currently at a high, it is likely to hit a new high on another day, even if it's only up 1 point. New market highs are made from previous highs. Don't be discouraged when the press points out each new market high. This is a meaningless statistic the news media just can't help following. We are in the fourth largest expansion since World War II. However, we are coming out of the deepest recession in the same time period, with the weakest recovery. There is a lot of room for expansion with growth-oriented policies. This chart shows an economy that has not been performing in line with historical averages. There is room for growth in this economy. As mentioned earlier, strength in the U.S. economy helps to bolster overseas economies. Overseas valuations are more attractive than domestic markets currently. Would you want to go back in time relative to the S&P 500 and invest at lower valuations? Well, that's kind of what's represented overseas. No investment is without risk, and this isn't a sure thing by any means. But the valuations are more attractive in the overseas markets than in domestic markets. So make sure your portfolio isn't too America-focused. Overseas diversification at this time can improve long-term returns. Historically, there have been cycles where domestic equities outperformed international and vice versa. The recent period was one of the longest periods of outperformance domestically. The expectations are for international to lead for the next few years. These expectations are driven not just by an historical perspective, but also by relative valuations. Looking at the long-term returns for international markets, we can see that they are only now recovering from being significantly below the long-term mean averages. This, like the previous chart of the same style, suggests there may be potential for higher than average returns as these markets revert to their mean. Trying to forecast the next bear market, let's look at past patterns. Bear markets generally occur in conjunctions with economic recessions. In conjunction with the recession, there are usually other factors such as a commodity shock, Fed tightening, and/or extreme valuations. None of these conditions are prevalent in the current economy and the markets. Few economists are forecasting a bear market for any other reason than it seems to be about time for one. So let's talk about what investors should do. There is a great deal of cash sitting idle in the economy. The chart on the right shows that over $15.5 trillion remains on the sidelines in various cash equivalent accounts. That is more than both consumer spending and mortgage debts. These cash assets are non-productive assets for growth, and they're fuel for further investment returns when they're finally put to work. The chart on the left shows that cash investors, and those that invest in CDs, are getting next to nothing for their patience. Sooner or later, investors have to take some risk in this market in order to make money. Investors in CDs are accepting that they are not coming close to keeping pace with inflation. The main market alternative to stock dividends is to take on interest rate risk in the bond markets. And as shown earlier, bonds aren't a good long-term proposition, in my opinion, if we realize rising interest rates. Over any 1-year period, almost any asset class may lead. Over any 5-year period, investors are generally rewarded for investing in equities. Over any 20-year period, there is no comparison. So, short-term needs, such as emergency funds, should be funded by investments in short-term assets like cash. Medium-term needs may be rewarded for having a portfolio allocation leaning to equities. But long-term assets should have a very strong leaning toward equities. Diversification and asset allocation do not ensure a profit nor protect against a loss. But bear in mind that this leaning towards equities isn't just before retirement. If we assume we're going to have a good 20 or 30 years in retirement, we're going to experience inflation. We're going to need to have growth in our portfolios in order to stay ahead of inflation, even in retirement. Equities are for the long-term investor. On a 1-month or 1-year basis, returns are as likely to be positive as negative. With a 5-year holding period, returns are far more likely to be positive than negative. 10-year holding periods were only negative during the fiscal crisis, and holding periods beyond that do not show negative returns for the investor. The 10-year and 15-year holding periods show a pattern. We call it an M chart. If history is a guide, we may be at the beginnings of another hump in the M, where returns outperform historical averages. It takes courage to invest. Even though the market finished positive 75% of the years in the last 38, the average year saw an intra-year decline of almost 14%. Those who would invest in equities should focus on their financial goals and not react emotionally to every market move. Complacency may become a significant factor, as investors haven't experienced historical market volatility for a while. When the markets become volatile, it can be stressful, and investors who only recently began investing may react emotionally. Note that even when the market doesn't finish positively, it never finishes on its low. Selling into a panic isn't a good strategy for wealth preservation nor for long-term growth. Now, we'd all love to be able to invest without risk. If I offered someone an investment which would have an average return greater than 7% per year, most people would jump at it. Well, that's the red line there. What that line represents, though, is the average annual return of the S&P 500 for the 20 years ended at the bottom of the fiscal crisis. As painful as the market felt in the dot-com bust of 2000 to 2002 and the fiscal crisis of 2008 to 2009, the returns for the long-term investor were still fairly robust, even at the worst of it. Oh, by the way, why do we invest rather than taking a guaranteed 7% over the long term? This chart shows what happens since the bottom of the S&P 500 to now. Guaranteed returns look good in the worst of times, but over the long term they create more financial opportunity loss in a portfolio than the short-term volatility of the markets. In this mathematical example, it would take a loss of over 50% in the S&P 500 to return back to the 7% average line. It's important to note here, though, that the S&P 500 is an unmanaged index. Some successful money managers have seen even better results. When investing in equities, do not ignore the power of compounded returns with dividends reinvested. After 47 years ended in 2017, dividend reinvestment brought a result greater than 4 times the price return alone. For the long term, taking greater risks tends to bring greater rewards. Note, though, that bonds did not keep up with inflation and the rising interest rate environment ended in 1981. All of the positive returns for bonds relative to inflation have come with the falling interest rate since then. In the commodity realm, consider the graph in the upper right. Those who bought gold at its peak in 1980 waited until 2007 to realize a positive return. When factoring for inflation, these investors still have not realized a positive return in real terms. Moreover, recent investors have seen a significant erosion of capital since its peak, greater than 1/3 of its value. So consider your asset mix. I'd like to show this chart to demonstrate volatility. Those asset classes which rise the most also fall the most. Another lesson is not to chase returns. What led in growth in one year is not guaranteed to lead the next year. In fact, oftentimes the leaders move to the bottom of the class. Maintaining a diversified portfolio has generally worked for the long term. What's on top doesn't stay there, and what's on the bottom will move up again eventually. Volatile asset classes will usually be found at one of the extremes. There's another story here. Up until 2008, a diversified portfolio beat the S&P 500 5 out of 7 years. Since then, the diversified portfolio has underperformed the S&P 500 in every year. This can cause investors to put aside diversification in favor of unmanaged indices. Despite recent experience, diversification is still important. In fact, even in this period, the diversified portfolio still has better performance for the long term. Where is a good place for investment dollars in terms of sectors of the economy? Looking at the sectors the same way we looked at asset classes, you find a similar story. Those sectors you find on the top will one day be on the bottom, and vice versa. This chart suggests that a contrarian investor selecting sectors from the bottom of the prior year may be rewarded in the following years. Another method of sector selection is going with the prevailing assumption that future interest rates will be higher than today. In that environment, it would be good to have sectors that are positively correlated to Treasury yields. In other words, sectors expected to rise as interest rates rise. On this chart, that would be sectors other than real estate, telecom, consumer staples, and utilities. Financials especially are expected to do very well in this environment. That doesn't mean defensive investors should seek only in securities in these sectors. They should simply make sure investment portfolios don't neglect holdings in these sectors if they agree with the investment premise. The 20-year annualized returns of available asset classes are shown in this chart. It would be logical to assume that a well-diversified investor would find their own return to be somewhere in the middle of these asset classes, as their returns reflect an average between them. But that isn't what we actually see. We find that the average investor has a much lower average return. In fact, at 2.3%, the average investor has barely kept pace with inflation over the last 20 years. If they had simply held any one of those other asset classes through the good and bad times, they would have been better off than trying to time the markets. Research shows that working with experienced financial advisors can help investors be consistent, even when it's difficult, and that has helped investment results. And I'm always happy to review and answer questions. The disclosure charts are a bit of an eye chart and hard to absorb in a video. So if you go to my website on the Capital Markets Review page, my slides are posted. You can get a better look if you desire. Thank you for watching this video. If I can be of service, my contact information is here, and I hope this has been beneficial to you.